chapter. I really wish those were different. They look like they're the same chapters. So this one is on internal controls. And this one is on the auditor's report. So it has the control auditor's report. And that'll be it. And that's kind of your you know, the kind of basic structure of auditing. If you want to go on for more, we do have a class called and this is advanced auditing. Oops. And advanced auditing is basically, we use the same book. It's basically chapters 10 through 15. And then also, I may have said that wrong. 10, I think I covered 10 through 14 and then chapter 16. But anyway, it's actually the kind of nuts and bolts of auditing. It's actually more interesting in this class, to be quite sadly bold about it. Because you actually learn how to do this, you know, how do you audit cash? So, you know, you walk into an audit and they give you the cash section. How do you actually do the audit of cash? That's what we kind of cover. It's more of actually doing the procedures rather than kind of learning the theoretical, you know, kind of stuff. So anyway, that's the Accounting 333 class. All right. So let's go to internal control. I think we stopped on number 6 here. Okay, so internal controls, and they're basically to see that management's objectives are being met. In our case, what we're really focusing on is the objectives of financial reporting. So ours is basically on financial reporting. It could be on other things too. Corporations have, you know, quality control for their products and all that kind of stuff. But for us, we focus on the financial reporting part of it. Okay. Smaller clients will usually have weaker controls. And why is that? I think you talked about this. I can't remember. Why will smaller clients usually have weaker controls?
Is it because they have less resources?
Yeah, they have less resources. They also have fewer people. Fewer people, and they also generally have less risk. And so we have less resources for it. They have fewer people and less risk involved in those things. One of the big ones is fewer people. You remember we have segregation of duties or incompatible duties. You know, authorization, custody of assets, record keeping. Well, if you only have, you know, so those 3 things must be separated. If you only have 2 people, you can tell right off the bat, you're not going to be able to have a segregation of duties. You're going to have people with incompatible duties just by the logic of it. You know, and so you run into those things, and even if you have 4, maybe 5 people, it still gets really tough. You know, think about all the different functions to have all these things, you know, to have a segregation of duty. It's just tough if you're people. but also the risks are less. And two, things are, for instance, management is usually more involved. A lot of times the owners are more involved. And that's one of the things we do in auditing is when you do run into it, you say, well, what do you do when you have a place that has very weak internal controls or maybe no internal controls? Well, a lot of times you'll focus on the owners, because if there's an active owner, the active owner will be working in their own greedy self-interest, and they'll keep an eye on things. And that narrows your field of who you have to, perform your audit. You'll do it towards that individual rather than, gee, it could be any one of these 50 people, in the upper management. Okay, well, it's probably only this one person in upper management, because for their own greedy self-interest, they're going to be looking after all this stuff. And now you just have to concentrate on them. For example, if you're a small bakery, you order a mixing machine, you'll know, when you order it, it's coming in, you're waiting for it. When it finally comes in, then you unpack it and all this kind of stuff. You don't really have a receiving department or anything like that. But the owner's involved and wants to do it. As you get to be a bigger, a bigger firm, a bigger, as the client gets bigger, okay, you have 40 bakeries. You're really not sure who ordered a mixing machine or anything like that, if you're the owner, or that they even ordered one. It's somebody else doing it. And so then, it becomes a little more difficult when a company is small and then they grow into a bigger one. If they only have 2 bakeries and the owner's involved, okay, that's, you probably don't need that many internal controls. You have 20 bakeries and the owners, they're not going to be that involved. There's no way they can travel around to 20 bakeries and, do all that. Then they need to get internal controls. And the problem you have is there's that time when a small business, a small client, grows into a bigger client that their controls need to grow up with them, right? You can't have just 2 people in the office when you have 20 bakeries or something like that. So you do run into this problem. So smaller clients use smaller controls. If the owner is active in the business, and focus the evidence on the active owner. And again, the idea is that it's in the owner's greedy self-interest that they make sure that things are getting done the way they should be getting done. Okay, and then also I'll put one more thing in here. As business grows, the client has internal controls required for the size of their business. And it's one of those things that doesn't always, it's not always, it kind of sneaks up on you. And, a lot of times they, when do they start doing something? When something bad happens. Some order gets completely messed up and they lose a bunch of money, and then they go, you know what, we need to, do something about it. But hopefully, as an auditors, you can kind of help them along the way to see what the internal controls that they have are, that maybe they've outgrown their old internal control environment. So you gotta be careful when a company gets bigger. Okay, inherent limitations of internal controls. Well, perfectly designed internal controls can fail. So you design these controls, they're absolutely perfect. You know, the internal controls kind of a process, but you know, the process, they're perfect, they're textbook, they're, you know, the way they should be, they can still fail. And this is kind of how that happens, the limitations of internal controls. Okay. The first one. Mistakes by employees. I told you guys about me working in a bicycle shop, didn't I? I don't know if I did or not. I think I did, but I'll bore you again. I worked in a bicycle shop when I was like, I think I was 14. Back then you could work when you're 14. And you didn't need a social security number. Yeah. Anyway, so I started working with, they hired 3 of us kids, high school kids, to work in this bicycle shop, and they had us all working the cash registers because, you know, we were starting out, and the people that knew how to fix bikes and build bikes and all that, they were in the back doing all that kind of stuff. So we were just kids up front selling stuff. So they had the old cash registers. And so you bring something up, people would look at it and go, I can't really read that. The ink's kind of bad on it. So we're all up there. We go ring it up on another register. And we go ring it up on another register. And what's the problem with doing that? Because we're trying to get a receipt that the customer will read. And, you know, we're kids, we're trying to, you know, please the customer. So what's the problem with doing that? What's the problem with ringing something up on 3 different registers?
You doing another entry for the service purchase?
Yeah, it looks like, you know, if there's been 3 purchases, it's really the same one. And notice that the registers are going to be short, right? I mean, because, you know, you're ringing up on these other registers, and you're not going to be putting, you know, that cash in there. It's going to go on, say the first register. We had no idea that what it rang up was supposed to be what was in the register, what was added to the register that day. You know, we made mistakes, and thankfully they were going to fire all of us, but thankfully one of the managers looked at it and said, why are these things getting rung up, you know, 15 seconds apart on all 3 registers? And we told them, oh, well, that's sometimes, you know, people, you know, they can't read the register, especially that register over there. You know, it's like, oh, okay, well, you can't do that. Anyway, here's the problem. So it looked like we were stealing from the cash registers. Here's the problem. Because we didn't know what the process was, you know, we didn't understand the internal controls, someone could have been stealing from the cash registers. Because there'd be no way you could have told it, because all the registers were going to be off. So anyway, so mistakes by place. Sometimes they just don't understand what they're, you know, what they're supposed to be doing. It could be a training thing or whatever, but it could be just mistakes made by employees. This next one used to be included in the mistakes by employees, but they've kind of separated this one out, and that is errors in computer programming. Again, that used to be included with this mistakes, but Errors in computer programming is a is brought out separately, and that sometimes there'd be system changes that while you may test them and maybe you know, you can go through all the testing of parallel computer implementation, all this kind of stuff, but you know, you gotta remember that computers are especially the programs are written by humans. They're tested by humans. You know, it's one of those things you can't really avoid, is that, especially things like software, there is a human element, even if it doesn't seem like there is. So errors in computer programming, probably the one that is the most serious is management override. So management override, this is when management overrides the system. So you're sitting there, you're an accountant and you're sitting at your desk, and you have your boss come in and say, I need you to put this journal entry in, and then I'll go approve it. You know, and you look at it, you say, I can't put that in. That's a fictitious entry. I can't put that in. And you say, well, you know, either put it in or clean your desk out. So, you know, it's up to you. Right? That's management overrides. When management overrides the control. So you may have a control that you put in journal entries, you know, the accountant puts in the journal entries and the manager approves them before they go in the system and all that. But if management overrides them, it doesn't matter what kind of controls you have. So management override is and by the way, that one is almost universally, that is what a lot of these big frauds anyways are. It's management wanting to bump up the figures. They can't stand the fact that their company that they're running isn't making the numbers they want or whatever it is. And, you know, they start saying, okay, well, let's do this. And they start overriding the controls that you normally have. And collusion. Collusion is two or more two or more employees working together to follow the controls, and these are usually have to do with the segregation of duties or incompatible duties. And you remember, by CAR, C-A-R. Collective assets authorization and record keeping. You keep those segregation duties. They're also called incompatible duties. that if you have these people get together and say, you have someone with the custody of the asset, someone with authorization, or someone with record keeping, you get any 2 or 3 of those together, you have real problems. And I have the wackiest auditing story I have has to do with that. At Navistar, used to be International Harvester. I worked at Navistar. It used to be International Harvester, and there were still auditors that were there when it was International Harvester. The 2 big tractor companies used to be International Harvester and John Deere. Case was also good, but regardless, so they made tractors, and so they got this tip off that in a tractor assembly plant in Minnesota, that someone was stealing a tractor a month. An entire tractor was being stolen from this assembly plant every month, which is hilarious because tractors are generally not sold, they're generally not made until someone puts in an order, and someone would say, hey, where's my tractor? If someone were stealing tractors. But regardless, they said there's the tractor month is being stolen. And tractors are all different, by the way. There's tractors for corn and wheat and different ground and all that kind of stuff. So they're almost all, they're kind of specialized, almost all more specialized. So they said, okay, well, we'll look at, and this guy wanted $2,500 up front and then $2,500 after the rest were made, basically. And so they agreed to it. And they met this guy and at the airport in Minnesota, this little airport, and the police and them get out in the field across the street from the assembly plant. And sure enough, at like 1 o'clock in the morning, all the employees go out on break, and a tractor drives up onto a truck, goes up the truck, and the truck takes off. The police go after it. And it was absolutely true. They were stealing a tractor a month. And the way they did it was through collusion. I think 27 employees, I think there's 29 employees charged, and I think 27 of them were convicted of doing this. But anyway, what they were doing is someone from the management on the night shift was scrapping basically all the parts for a tractor every month. So they say, okay, this engine came in, it fell off the forklift, we're scrapping it. All these wheels came in and they were damaged, and we scrapped it, whatever. They would scrap an entire tractor every month, keep the parts, and then put it together during the shift and sell it. And people could, the criminals could actually order what kind of tractor they wanted, because, if you wanted this engine, okay, we'll scrap one of those engines, and not really scrap it, we're going to put it over here in the corner. And they were building a tractor and selling it. And it was on the night shift. And here's why the guy did it. He got it was a union thing. He got transferred because he was in the union. The people don't want to work on the night shift, they want to work on the day shift. He got transferred to the day shift, and they cut him out. So he was mad that they cut him out, and he turned him in. But anyway, when you get 27 people, oh, by the way, not only was there a manager involved in it, there's also an accountant that would work the night shift. There was a night shift accountant that was in on it. So you had people who get authorization, you had people working on the floor they have the custody of the assets, the wheels and engines and transmissions and all that kind of stuff. And then you have the record keeping guy, the accountant. And you say, well, how can you prevent that? You can't. There's nothing you can do. If 27 people get together to do something, there's not a whole lot of controls that you can have to change that. And people always say, well, there has to be some way, how can we keep this from ever happening again when something bad happens, Enron or anything like that. How can we do this, And the sad answer is you can't. And, and I was not really joke, but I say, if we're going to stop some kind of crime, let's start with murder and rape and assault and all that first before we get down to. But you really can't stop it. So these are things that no matter how well you design the internal controls, that you can't stop. And I know that people don't like to hear that, but that is really the truth. And sometimes people say, well, they should make this illegal or that illegal. It already is illegal. So is murder, right? I mean, you know, it doesn't necessarily stop those behaviors from happening. So anyway, these are the limitations. F. A client's associate treasury director and staff accountant colluded to embezzle thousands of dollars from the client. How could this situation have been avoided? Oh, there's an error in here. It should say from. Change that for to from. Prohibit Treasury Department's employees from accessing cash. So yeah, change that for to from. All right, so which one of these is the correct answer? It's going to be D. It cannot be avoided with internal controls. You know, lie detector tests are, you know, those are very unreliable. You can't prohibit Treasury Department employees from accessing cash. That's pretty much all they do. And installing cameras in the work area, they're probably not scheming this in the work area. It's probably someplace outside the work area that they're doing it. I mean, you can look at it, but even then, you know, it'd be hard to tell if they were doing something bad. Okay. So again, this is one of those things that, you know, a lot of times people don't like to hear just because it sounds like you're not doing anything, but there are limitations to internal control. And again, one thing you got to remember, internal controls are designed by humans, they're created by humans, humans implement them, humans try to find ways to get around them. The only way to avoid that kind of stuff is to take the humans out of it, which you can't really do. Okay. Communication of internal control deficiencies. So what happens when you find internal control deficiency, something that is a weakness in internal control? What do you do with this? What they call deficiencies, it could also be called weakness. But what do you do with it? Well, it depends on how big and bad it is. Oops. If it's material, you have to tell management and the audit committee. If it's significant, you have to tell management and the audit committee. Now, herein lies something kind of strange about the rules for control deficiencies. The real rules on it is that anything significant must be reported to management and the audit committee. So anything that's significant. Material deficiencies are by definition significant. So material is more than significant. So by definition, if it's material, it's also significant. So when you're reading the rules on it, you read it, you say, oh, this only has to do with significant. It also has to do with material. Material is a larger concern than significant. I know it's kind of definition-y, but any material deficiency is also a significant deficiency. And again, the real rules talk about significant deficiencies. Those also cover things that are even worse than significant. They are material. So significant is less than material. Less than significant control deficiencies, those are generally done by oh, wait, these have to be written. Less than significant control deficiencies, management, and they could be written or oral. It would strongly be advised to be written. But you got to remember, these are insignificant. So if they are insignificant, it's actually a much lower level. Sometimes in audits, management will ask to have all internal control deficiencies or weaknesses reported, and then you just report all of them. Sometimes, well, and two, I should mention this. This comes up in the next chapter, actually. But you're also going to tell the board of directors that, look, things that are insignificant deficiencies, that we have also reported those to management. So they won't know specifically what they are, but you let them know that things that are insignificant, you report it to management. And then they can ask management if they want about the insignificant deficiencies. Okay. I think we already talked about this. No, maybe we didn't. Substantive testing timing. Close to the balance sheet date is better evidence. So there's nothing wrong with, and later on we'll talk about interim testing. There's nothing wrong with interim testing, but the best evidence would be on the last day of the year, especially for things like on the balance sheet. And remember, the balance sheet also feeds into, we talked about, the testing of it. The balance sheet feeds into, cash feeds into the income statement, with the revenues and expenses and all that kind of stuff. So the closer you can get to the balance sheet date is really the best evidence for where you get the best evidence. The problem, so you might say, why don't we just do everything at that date? Well, you don't do everything at that date because it may be time prohibitive. And two, you realize that if you're, let's say you're going to take a sample of the sales for the entire year. Well, okay, so if you're doing a sample of the sales from January, say, to October, you can do that, say, in November. Test those sales in those months, and then just pick up for the last 2 months when it comes to a year end. So you can get a bulk of the testing, which is the real time-consuming stuff. You can get a bulk of that done beforehand, right? So that it's just for a timing scenario, it's usually easier to do. Okay, low detection risk and high detection risk. These can be somewhat confusing. Low detection risk. Example, let's say 2%. And this is usually required for companies that are riskier. And let's think about what detection risk is. Detection risk is the auditors detecting a material misstatement. So if you have a risky client, okay, now you're on alert. You have to get more evidence because it's a risky client, could be risky for a number of reasons, whatever they are. But a riskier client requires more evidence. You're trying to lower that detection risk, the risk that you might miss something. So you're going to lower that. How you lower that? You get more evidence. So maybe at a normal client, you would take a sample of whatever, 300 accounts receivable. If it's a riskier client, maybe you take 700 accounts receivable because you say, okay, there's a riskier client. We need more evidence. We have to lower that detection risk. So this is. And this is controlled by the this is the auditor's work. And truthfully, detection risk is the only thing auditors have control over. You don't have control over inherent risk or control risk. The only thing we can do is if something goes wrong is focus on what we're doing and try to detect any material misstatement. So riskier client, naturally, you're going to test more because there's a bigger, a higher likelihood that something's going to go wrong. High detection risk. Say, I don't know, 10%. With the opposite. High detection risk means that there's a higher likelihood that you're going to miss a misstatement. Now, the reason, again, you might back off on that detection risk is that the other risks are so low. If there's very low inherent risk, very low control risk, in other words, they run a really tight ship, maybe you've audited them for years and you've never found anything even close to material, low risk, you don't have to audit to the higher stand, I shouldn't say that would be confusing. You don't have to audit to those lower detection risk amounts because they're not as risky. So from an auditor standpoint, if a client is riskier, you have to lower the detection risk, lower the likelihood that you're going to miss a material misstatement. The only way you can lower that is by getting more evidence. So low risk, get a bunch of evidence before you sign off on that report because the client's riskier. The client's less risky. Okay, you don't need to, you can be fairly certain based on their internal controls and how well they're working, and maybe even in the past, your past experience with them. If you have a client that you've never found anything wrong with, something along those lines, well, you can back off on the control. You say, okay, we don't, or the testing of it. So you get less evidence because the overall risk will be pretty low because it's usually the client has a low risk anyways. So high detection risk is really allowing for, you know, a higher amount of detection risk. So you take less evidence and allow for clients that are less risky. Isn't it? And sometimes, by the way, sometimes you get CPA questions and they'll say, oh, you know, if you're into a client that is you're going bankrupt, what will that do to your risks? And they'll say, you know, you have to change the inherent risk. You can't change the inherent risk. Don't change the control risk. You can't change the control risk. Those are both with the client and they're also in the past. They happen during the year. The only thing that you can change is the detection risk. And if the client is going into bankruptcy, it's a riskier client. That means you have to lower the detection risk. You know, get it down to whatever, 5%, 2%, 1%, whatever it is. Lowering that detection risk that you're going to miss something. If the client's doing really well, you don't have that problem. Interim testing, I just talked about this for a little bit. This is testing throughout the year. And a lot of times it's for certainly things like test the controls and those sort of things. I worked with, when I was working at Navistar, our auditors were Deloitte. Actually, when I worked at US Steel, our auditors were Deloitte. But we had Deloitte was our, they were our auditors. And I remember working on, we had a whole bunch of retirees, pensioners when I was at Navistar. We had 11,000 employees and we had 39,000 pensioners. We almost had like 3.5 pensioners for every one active employee. So our pension plan was huge. The pension plan had assets way more than the company did. But we had 35 different pension plans. Some for workers, you know, workers that were hourly workers or management workers and all these different plants, you know, all over the place. And so pensions was really big. So in the summer, I was doing work with them on the pension plan and doing audits of payments to these pensioners. And I mean, and they took forever. I mean, because you had to find all these different, you know, this person worked for 6 months here, then they're transferred to this plant where they became a manager. Then they went to an hourly worker at this plant, and then, you know, they had all these, and you had to figure out, okay, you know, they worked for this long for this pension plans, you know, so it was, it took a really long time. There was, I think the sample was 35. At first they gave it to a new person auditing, and it was just crazy. Even for myself who had worked there, you know, for a while, it was, it took a really long time. It took like 3 days to go through a sample of only 35 of them. But anyway, they were doing the testing of the internal controls, and kind of not surprising that internal controls were excellent, because it was literally the most important thing in the company was those, and you know, it's one of those things that the company watched very closely because it was big dollars flowing out, But also the pensioners would watch and say, look, no, I'm supposed to get more money if this is, if it's wrong. So you kind of had both sides that were very interested in it being correct. And but the controls are pretty good. But okay, now the weird, not weird, but this is guaranteed to be on the CPA exam. System organization and controls. These are called SOCs. So there's a SOC 1, a SOC 2, and a SOC 3. So system organization and control. So hold on a second. I should say service organization. I may have that wrong. Hold on a second. I guess it is system organization controls. I thought it was service organization controls. Okay, so I am right on this one. Anyway, it's for service organizations. So we may have, so these are some examples of it. ADP payroll services, electronic commerce. You saw things on, Amazon and Walmart, internet services. So these are all service groups. Okay, this down here is kind of explains what the problem is for it. I just did was a problem. So suppose Roosevelt University uses ADP for the payroll. The external auditors must obtain sufficient appropriate evidence about this. So this is important. Just because you have somebody else doing it does not mean you're off the hook of figuring out if they have their controls in place and that they're not materially misstated. The dollar amounts are materially misstated. So just because you go to an external payroll doesn't get the auditors off the hook as far as saying, oh, we don't have to do anything with that because it's somebody else's job now. You're signing off on those financial statements, and every number on those financial statements is covered by the audit, whether it was done by ADP or whether Roosevelt did it themselves, the payroll. So you have to get, comfortable with the dollar amounts, but also the internal controls of those groups. Now, here's the problem though. Okay, so, however, ADP has thousands of customers like Roosevelt. ADP cannot have thousands of auditors walking through their facilities, evaluating the internal controls. So Roosevelt University uses ADP. McDonald's uses ADP. All these different companies probably use ADP, you can't have thousands of auditors going and auditing the controls of ADP. It just doesn't make sense. So what you do is you have an audit report from those service organizations, and that audit report is used for the internal controls to see if the internal controls are functioning, basically, for the, you know, whatever it is. In this case, it'd be payroll, but it could be for internet services. It could be for you know, working on Amazon, what the controls are for Amazon and all that kind of stuff. All those service organizations, they can't have a billion auditors. We're not, you know, I mean, you can't have a lot of auditors walking through it. So they say, okay, we're going to have auditors come in, look at the controls and write a report. And that report is used by other auditors. So the report will be used by other auditors in place of them walking through and valuing the controls themselves. So a CPA firm will come in, audit the controls. The reports, there's 3 different kinds of reports. There's SOC 1, SOC 2, SOC 3. By the way, these are trademarked by the ACCT, but they're very common. So those reports are available to auditors and other people we'll talk about in a second, but it's so that people can be comfortable or not comfortable with the internal controls of a service organization. Okay, so the first one is the one that we would probably be most familiar with, and that is SOC 1. It's only on it's only for external auditors. So the SOC 1 report is only for external auditors, and it's only for financial reporting. So SOC 1 is for financial reporting, and it's only for the external auditors that they can use that as in that report they'll use as their evidence of the internal controls of ADP for the payroll. So they're auditing Roosevelt. If we use ADP, that ADP, that report on it, we will use that as our evidence of internal controls for ADP. So the SOC 1 is for external auditors. All of these reports basically have 2 different types, type 1 and type 2. The first one is for design only of the controls. The second one, they check the design of the controls, but also the operational effectiveness of the controls. So it's a higher level. So you can have SOC 1, SOC 2, SOC 3, and they can be type 1 or type 2. Okay. I tell you what, let's stop there. I thought I'd be able to get through this, but obviously I'm not. Was it 7:10? Okay. Yes, we'll stop there. But by the way, these SOC reports. We're going to look at one of them in a few minutes here. But these SOC reports they're made by the AICPA. They're the ones that have trademarked these reports. And in the past, we only looked at the SOC 1 report because that was only for auditors. But nowadays, SOC 1, SOC 2, and SOC 3 reports are tested on the CPA exam. So anyway, we'll be back by 7:10. I'm going to kind of give you an overview of the SAC 1, SAC 2, and SAC 3. All right. So SAC 1, this is for financial audits. And it's detailed. It is not for the public. SAC 2. It's for management. It is very detailed. And it's not for the public. So the financial audit one is detailed, but it's only detailed to the point it needs to be for auditors of the financial statements. The SAC 2 is more for management, and it has everything in it. It will have stuff from financial audits, but it'll also have everything else. Like, it'll have for instance, if it was a payroll system, it would have all the controls over the payroll that would be in there. It would have all the legal stuff in there that would, for managing payroll, all the efficiencies and all those kind of stuff would be in there. That wouldn't be in the financial audit. And we do financial audits, we don't worry too much about the efficiency of a control. But so these are very detailed. They're also not for the public. So both of these, SAC 1 and SAC 2, are not for the public. SAC 3, we copy it. Is for the public. It is it's not detailed, and it's some kind of like a summary or overview. So we have SAC 1, SAC 2, SAC 3. SAC 1 and SAC 2, people who aren't in management or in auditing will never see these. They don't need to see them. There's no need to see them. So SAC 1 is for financial audit. SAC 2 is for management. It's very detailed. This is probably the most complex of them. All the reports out of the SAC 2. And the SAC 3 is one that if someone wants to know, for instance, you get let's say the payroll thing. Someone asks, well, how do they actually, what controls do they have over my payroll check? You can hand them the SAC 3 report, and that will tell you what kind of controls they have over your payroll check. It's for everybody. It's written in a language that is accessible to everybody. So SAC 2, again, this is more detailed. This is along the lines of somebody who's thinking about using, say, ADP, and they want to know, information about how it's processed and all that kind of stuff. The SAC 2 report will be used. It's for making decisions, basically. And the SAC 3 is for everybody. Me, you, everybody can do it. Again, they still have the same type 1 and type 2, but it's for everybody. Now let's take a look at what a SAC report looks like. And this is the SAC report. Some of these, they really vary quite a lot. but they usually like between like 20 and 80 pages, something like that. And so this is a system and control report. This is for, who's this? Amazon. So this is for Amazon Web Services. And I gotta move some stuff here. This was done by Ernst & Young. Here's the CPA firm. Hey. Oh. So there's Ernst & Young. They're a CPA firm. They're the ones that did this. And this is done on October to March. Reasonable assurance. Okay, so there's a report on it. And then it'll go into explaining a little bit about the different things that they looked at and what the questions you may have. We're not going to go into all this stuff, but so that is what a SOC 1 looks like. And oh no. And you can tell that, even that one was what, 37 pages. So you can imagine a SOC 1 is probably way more detailed than that. And a SOC 2 would be, I'm sure, incredibly detailed, all the different web services and securities and all encryptions and all that kind of stuff would be in there. But so they're kind of involved. But again, these reports are generally there for giving somebody some assurance, in our case, the SOC 1, that the controls are functioning as they're expected to be. And we use that as our evidence, that report. Okay. Auditing internal controls. And these are kind of boilerplate stuff. Management must accept responsibility for the controls. They must evaluate the effectiveness of the controls. Notice they don't talk about the efficiency, just the effectiveness. Management must support their assertion. And give a written assertion. So basically, management has to accept responsibility. They have to come up with an assertion about the internal controls of how well they're functioning. They have to back it up with evidence, and then they have to have a written report saying about how their internal controls are functioning. Okay, so there's the 4 things that have to be there to do an internal control report. Now, publicly traded companies are required to do this. So this is not a, gee, we should do this. This is integral to their regular report. One more thing that's a little bit quirky about it. The report on internal controls has to be done in tandem with a financial audit. So a publicly traded company, they could just have a financial audit, but then they'd have to have another financial audit and the internal control audit. So obviously, I don't know if there's ever been a case where a company hasn't done those 2 together. So an internal control audit requires a financial audit. So you can't just walk in and do an internal control audit. You have to also do a financial audit at the same time as the internal control audit. And one of the reasons for that is this, indicators of a material weakness. In other words, if you don't do a financial audit, you may not find those things that are. So for instance, discovery of any fraud. So if you're doing the regular financial audit and you discover fraud, well, that indicates there might be a material weakness in internal controls. That's why they make you do a financial audit at the same time. Restatement of financial statements. So if they're restating the financial statements because of an error, that might also indicate it. Communication of any material misstatement during the audit that was not detected by internal control. Now, again, this could, if it was one of those inherent limitations, there's not a lot you can do with it. So if there is a material misstatement and it was due to collusion or something like that, there's not a lot you can do with that as far as internal controls are concerned. But if there was a material misstatement that could have been caught by an effective internal control, there you go. There's your internal control weakness. Ineffective oversight, reporting controls, those charges. Okay, I'll underline it, but it's okay. Any identified material weakness or significant deficiencies should be communicated in writing by the report release date. For government agencies only, it must be occur within 60 days of reporting the release date. Another thing for government entities, it's not in here, but another thing for government entities is that a lot of times that they will require that you report all misstatements, not just material ones. You don't make that distinction for governmental. A lot of the governmental, they say we want to know all the problems, whether material or not. We'll make the decision whether they're material. As auditors, you don't. So a little bit different. Lesser deficiencies should be recorded. Oops. Let me do that. Should be communicated in writing to management of 60 days. So they have this kind of 60-day rules. You cannot report on that there are no deficiencies. So you cannot say that there are no either material or significant deficiencies, or that you remember that we only do reasonable assurance anyways on the audits. So you cannot make a statement saying that there are no material or significant weaknesses. Now, management may want you to. Well, can't you just say a statement saying, that we want the board of directors to know that we're doing a good job, and can't you just not? You can't do that because it's only reasonable assurance. And second of all, because internal controls are a process, it's dependent on other things that can go into it. So you can never say, oh, there are no material weaknesses, there are no significant weaknesses or deficiencies in internal control, right? Now, when you have those, you can report them to the board of directors, but you can't do the opposite. You can't say, hey, everything is great, because again, it's you don't know that there are no material weaknesses or significant deficiencies. Okay. This is one of those things that I draw a big heavy sigh when I talk about. COSO. It's on the Committee of Sponsoring Organizations of the Treadway Commission. This is just called CASO. There's also a guide work for enterprise risk management called ERM. And that has to do, you can't see what I'm doing. So CASO. And enterprise risk management, which you may have in your other management classes, ERM. And you'll notice that these are, they go hand in hand. Risk management and internal controls are related. Right, so internal controls and risk, again, they go hand in hand. We know where there's risk, you should try to use internal controls to try to mitigate that risk or reduce it or detect anything that goes wrong or prevent it to go wrong, whatever it is. So risk and controls are go together. Let me put that in here. And we don't just make controls for no reason. We make controls to mitigate risks or to try to prevent risks or what, however you want to put it. Okay, so and so the reason I say this is a lot of times you'll see this listed as CASO ERM. So committee and sponsoring organization and enterprise risk management structures. So here's the problem that they were coming up with. Companies were saying, well, look, we got all these different definitions of internal control. You know, the IT department has their own internal control stuff. The finance people have their internal control stuff. The auditors have their internal control stuff. The accounting department has their internal control stuff. Operations has their internal control stuff. There's all these, you know, we want all the internal controls. Basically, we're going to have this framework that if you ever have a question on internal controls, you go to this framework and this framework should explain it. Okay, sounds great. As you might imagine, this gets really complex really quickly because it isn't like you're eliminating any of the internal controls. It's sort of like everything in the kitchen sink in there too. So if you're an auditor, there's going to be a lot of these controls that have nothing to do with you, but they are part of internal controls. And we will look at the financial parts of those controls. But when you look at this whole structure, it's not just for auditors, it's for everybody. Okay. So these are the groups. The accounting people are in there. The AICPA, which is the kind of the auditing side of it. The finance people, the management people, and the internal auditor people, those are all in there. And they are all part of the CSO framework. And these are the things that the components of it. And we're not going to go through all of these, but we'll go through some of them. Okay, so the control environment, the environment in which the company works in. This is probably the biggest one that they, if you're doing auditing, that's the biggest one they're going to talk about. A commitment to integrity and ethical values. You can read through some of these. Let's see here. This is an important one too. The internal control holds individuals accountable for their internal control responsibilities and pursuit of objectives. I'm blurry. Camera, what are you doing? Let's switch cameras and see if it comes back. I look better as a dog. Okay, I did an audit one time that they had people that were what they call padding their expense reports. They're putting, it was fraud, putting things on the expense report that really didn't happen. Anyway, they had a supervisor that signed off on these audit reports that had a bunch of fraud on it. And so when we're talking to the guy's like, you know, the guy who was a salesperson, the sales force guy, and he's like, well, I thought you guys looked at those. He's like, I don't look at those. You know, I wouldn't know how to look for fraud. And so then, you know, you come to, okay, why is the, you know, why is this person signing off on these reports as if it's a control when it would, you know, it's clear that he either doesn't know or doesn't even care to know how the, you know, what he's signing off on. And two, the way that it was written, this, you know, that managers must sign off on, or supervisors, whatever, must sign off on these expense reports. There was no indication as to what happens if there is a fraudulent report, or what, you know, what to do if a supervisor does find a fraudulent report. What does it mean when the supervisor signs off on it? Does that mean it's okay regardless of what's on the report? So there's all these things that it was very unclear the way it was written, what the signature of that means. You know, when the supervisor would sign off on the expense reports. The supervisor obviously very, you know, he said, yeah, I looked at them, but hey, you know, I figured you guys would look at them. If there's a problem with them, you guys would come back and, you know, talk to whoever sent in the fraudulent report. I didn't know it was up to me to find that kind of stuff. So it was very unclear. First of all, what the signature even meant, but then like the responsibility for it. There was, it seemed that there, in the end, basically nobody was responsible for looking at those reports. So it's good to have nice, clear lines of the people are accountable for different things in it. Risk assessment process. This is one of those things that in the past was kind of ignored. And nowadays it's right up there near the top. And that is that the organization specifies objectives with sufficient clarity to enable the identification and assessment of risk objectives. Okay, all internal controls are for some kind of type of management objectives. So you need to have really clear objectives so that you can have clear controls over those, whatever those are. And it could be for, ours is financial reporting. It could be for production. It could be for anything. Okay. We'll do this piece here. Control activities. This one is one of those things that we have talked about, I think. Yep. Did we talk about this? Maybe we didn't. You know what? The more I think about it, we probably didn't talk about these. Oops. PIPs are performance reviews. Something called independent checks, management review, or management review controls. The performance reviews are not, as an employee, you have a performance review every year. It's not really that usually. What it is that there are, if there's a, say, a budget that says, okay, we think we're going to have this much in sales in January, that someone goes back and looks over and see whether those sales are right or not. Or if there's a budget for spending, comparing those to, you know, the budget, someone go back and review and see if those things match up. So what we're really looking at, the performance reviews are not like so much for employees that they'll have a performance review every year, but that how the company is performing, that will be reviewed. And usually they review that by comparing it to budgets and what they are. And if there's a problem, that it should be taken care of. So for instance, they always use the scenario of a $6 million stapler. Someone has a $6 stapler come in and they enter it as 6, and you know, they get bothered and they put in, you know, all the handout, and it goes in as a $6 million stapler. Hopefully something in the system will catch that. And if something in the system doesn't catch that, well, then we go to performance reviews. It'll hit somebody's budget. And someone will say, hey, wait a minute. I don't think I have a $6 million stapler. What happened? Okay, so this would be, so for instance, this is usually is tied to budgets. Information processing controls. Now, it could also be that you have a limit control in the system that says limits the cost of things that being entered. Maybe there is a limit of $1,000 or something like that, or something at a certain level that it has to be approved or whatever it is. So someone can't put in a $6 million stapler. And it also may have things in there like logical tests, like you can't put in a negative number. So someone might be entering the cost of a stapler and go, oh wait, it costs $6, so it'll be a -6. They put in a -6. Well, it's not a -6. It's the cost is just 6. So you have these kind of controls over the internal the information, the IT controls. Physical controls. Physical controls are really keeping a lot of secured areas. So, they may have an information processing room. I'm an accountant. I have no business being in the information processing room. I can't go into the information processing room. Only people that are IT people that have a job to do that they need to get in the IT processing room can get in there. They have a card and face recognition, whatever it is, that they can't get in unless they are approved. So it's a physical control. I can't even get into that room even if I wanted to. It's physically keeping me out, which is kind of rude. Okay, and segregation of duties, which we talked about. So those are the control activities. We remember them as PIPs, performance, information system, physical, and segregation of duties. Okay, let's see here. Monitoring of controls is a real important thing. These are both actually. Yeah, these are both actually important ones. So the idea is a couple of things. Just designing the controls, they should be monitored to see if anything is coming out of the control. So if you have a control that's supposed to prevent a $6 million stapler, you want to have some kind of report that shows if people are trying to put in a $6 million stapler and maybe figure out why they're putting in a $6 million stapler. But the controls should be monitored not only for their output, but to see if they are working the way they should be working and preventing it. So someone puts in a $6 million stapler, you find it in the, compared to the budget, someone yells about their budget and the control didn't catch it. Well, that's kind of, it's a monitoring of the control. Okay, why didn't the control catch it? Furthermore, controls evolve as business evolves, as threats evolve. It's kind of 20 years ago, we didn't worry too much about cybersecurity. You had viruses that kind of were malicious and sometimes would wipe out your computer or something, but it wasn't like someone would steal your identity or anything like that. So, over time, these things evolve and the controls have to evolve. When the risks evolve, the controls have to evolve. So monitoring is really important to see if they are evolving with the risks. Okay. We'll finish up with Casco and that'll be it for tonight. we won't get to 17 today. Okay, CASO, organization objectives. You'll notice that these are suspiciously similar to our types of audits. So these are the organizational objectives: operations, reporting, and compliance. And again, these are very similar to the audits that we do. Operational audits for effectiveness and efficiency. That's one part of it. Financial reporting, that's the part we're, as external auditors, that's the one we're interested in. And then also compliance audits. Could be compliance with the IRS, could be compliance with, say, government grants or government contracts or whatever. So those are the three areas that we have, and those that are really the types of audits that we have. Okay, and the organizational levels. They have an entity level, for instance, General Motors. And they have a division level, for instance, auto manufacturing. So General Motors, maybe they have financing and auto manufacturing. Well, they would have a auto manufacturing. Operational units, the Buick part of auto manufacturing, and function. There's an auto assembly plant in Wisconsin. Not very specific, but it's Wisconsin that is making Buicks. And that gives me to the most confusing thing you'll ever see. This is the CASO cube. So this is the CASO cube. You'll notice it has the three types of audit reports, or the type of audit reports. We have operational reporting, and compliance. This is financial reporting and compliance. These are the 5 components of internal control, and then they also go for the 4 levels of it. So it goes across all 4 levels for operations, reporting, and compliance, and then these 5 areas of it. And again, it's one of those things that it gets very complex very quickly. This CASO, but it is one of those things that they are testing on the CPA exam. I know they tested it more recently. I don't know whether it's been more in the last couple of years or so, but this kind of came about maybe, I don't know, like 15 years ago. It kind of got steam. And now it's developing more and more every year. And now it's basically called the CASO ERM model. And if you take the CPA exam, you'll see it in there. It's a lot, and this is one of those things that I would say you would not want to study this until close to when you're taking the exam, because you're going to be memorizing some of the high points of each of these areas before you take the exam. So it's kind of involved, but it's also, and the idea of it is, I think, is good. It's just it's a little bit much considering as for a CPA what we're really looking at for the internal controls over financial reporting. So anyway, CASO, SOC reports, those are 2 things that are there. Of those 2, I think the SOC reports are going to get more coverage than probably the CASO. They're newer, and they're also made by the AICPA. There's one thing about the AICPA, you look at the CPA exam, and they are maybe a little bit biased as far as what they put on it, and that their stuff gets put on it that they've been working on. And their argument for it might be, hey, we're the biggest, group of accounting people, the most influential in the United States, And the things that we're interested in are probably things you should be interested in too. So, you know, that it's not that it's completely underhanded or anything like that, but it's kind of just the way it is. But anyway, the SOC 1, SOC 2, and SOC 3 reports are going to be on the CPA exam, and they for anytime into the future. And in the past, it was only the SOC 1 report that they really looked at, but it's going to be all three of them going into the future. Okay, any questions? Let's stop there. So I think what I'll do is I'll put the so this will be the chapter 7 handout. Am I still on? I am. I'll put it in right now as we speak. Chapter 7 handout, it is due on April 29th. I'll put that in and you guys can submit that. Okay. So the chapter 7 handout is available. And so next week we will do the chapter 17. And then I'll send out the exam. The exam will be on the chapter 7 stuff and the chapter 17 stuff. And it'll be due by the 2nd of May. All right. Any questions? All right. Well, sorry for boring you with the internal control stuff, but I'll see you guys next week.
Thank you.
Thanks, guys.
Sounds good.
Good night.